This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Chapter 2 of Accounting for Humans, Business Numbers Made Easy, breaking down the income statement. Let's dive in. A company can report record sales and still be quietly bleeding money. In one recent year, Amazon brought in about $500 billion in revenue and ended up with a loss. How does that even happen? Let's step into the story hidden between sales and profit. Here's where the income statement starts to earn its keep. It doesn't just show what happened, it shows how it happened, step by step. Think of it as tracing a recipe backward. You start with the finished dish at the table, then walk through each ingredient and technique that shaped the final result. The top lines reveal how much business the company actually did, how much value it pushed out the door. Then, line by line, you see that value get chipped away, first by the direct costs of delivering what was sold, then by the day-to-day costs of running the organization, and finally by items that sit outside core operations. By the time you reach the bottom, you're not just seeing a number. You're seeing a trail of decisions, trade-offs, and risks that turned activity into outcome. On paper, this trail is structured in a surprisingly consistent way. Regulators and investors expect companies to follow clear rules, so that one firm's story can be compared with another's. Under U.S. GAAP, most public companies use a multi-step layout that separates everyday business activity from everything else. IFRS permits more flexibility, but the building blocks are similar worldwide. For you, that consistency is powerful. Once you learn how to read one statement, you can decode almost any company's financial narrative, from a tiny startup to a global giant. Start at the very top, the period the statement covers. Month, quarter, year. It matters. A business that looks fantastic in a single quarter might be propped up by a one-time deal, while a slightly meh year can hide powerful improvement over several quarters. Always anchor yourself in time first, or you'll misread everything underneath. Next, scan for how the company slices its business. Many statements break out multiple revenue lines, product versus service, different regions, or distinct segments. This is where you see which parts of the business are actually pulling their weight. A software firm might show slow hardware revenue but fast-growing subscription lines. That mix tells you far more than the total alone. Below that, watch for how the statement frames cost structure. Underneath the familiar subtotal of gross profit, the operating section is often grouped into selling and marketing, research and development, general and administrative. The exact labels vary, but the pattern is revealing. A young growth company may pour money into R&D and marketing, accepting thin operating margins to build future advantage. A mature utility might show modest R&D and very stable operating income. The proportions hint at strategy before management even speaks. Then there's the quiet divider between what's operating and what's not. Items like interest income expense, investment gains or losses, and foreign exchange swings live below operating income on a multi-step statement. This separation lets you ask, if I ignore the financial side effects, is the actual business engine strong? Amazon's 2022 numbers are a classic case. Core operations looked very different from the bottom line, once big investment valuation hits were included. Taxes add another wrinkle. Don't just note the tax bill, compare it with pre-tax income. An unusually low or high effective tax rate can signal tax credits, loss carryforwards, or geographical quirks that may not last. Finally, resist judging by a single bottom-line number. Lay several periods side by side. Are margins drifting up, holding steady, or eroding? Are costs growing faster than the activity that's supposed to justify them? Over time, those patterns are far more telling than any one year's headline result. Now put this into a concrete scenario. Say you're comparing two companies in the same niche. Both show similar size and growth on their statements, but their paths down the page diverge. Company A's margins are thin, yet its selling and marketing and R&D lines are climbing as a share of revenue. Over 3 years, operating income barely moves, but customer counts and new product launches surge in the footnotes and MD&A. Company B, by contrast, keeps those lines flat while squeezing incremental gains in operating income via small efficiency tweaks and headcount controls. One isn't automatically better. Company A is effectively telling you, we're spending today to own tomorrow's market. Company B is saying, we're optimizing what we already have. Side by side, the structure of their statements doesn't just show outcomes, it reveals two very different playbooks and helps you decide which future you're actually betting on. Regulators and investors are quietly sharpening the spotlight on how results are earned, not just how much shows up at the bottom. Expect more visibility into carbon exposure, data privacy fines, and AI spend, line items that once hid in vague other buckets. Like a chef's tasting menu, the sequence and detail of each course will matter. Not only what appears, but what's been removed, recast, or sweetened with adjusted figures to smooth an uneven kitchen. Treat each new P&L you see like a draft painting. Step back, then lean in. Notice where colors, segments, deepen, where shadows, one-offs, collect, where brushstrokes, spending shifts, suddenly change direction. Over time, you'll stop asking, is this business doing well? And start asking, why does this picture look this way now? Before next week, ask yourself, 1. If I look at the last 3 months of my income statement, which 1 and 2 expense lines, like software, contractors, or ad spend, surprise me the most, and why haven't I questioned them sooner? 2. If my revenue dropped by 20% tomorrow, which specific expenses on my income statement would I cut first? And what would I change about my business model to protect my profit margin? 3. Looking at my gross profit and net profit from last month, what is one concrete change I could make this week, such as renegotiating a vendor rate, adjusting pricing on a key offer, or dropping an underperforming product that would move those numbers in the right direction? This was OwlUp, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!